Thank you very much, Sean. Thank you very much, everyone. I want to welcome you for actually a special presentation in our Wednesday's class. I'm just so blessed and grateful to have a good friend of ours in our community, Jean-Claude. Uh, Before Jean-Claude starts, just a few, I think some very timely subjects we're going to speak about. One of the things we have to consider, there's a lot of people can talk about the things that they have studied and they've done. The doctors and the students of medicine, they can say, well, they have studied this, but very few people have actually done the actual things. When it comes to um, structuring things and surgeons doing actual surgery. So um, our guest is the one who, while he speaks about the theory of investing, he's actually structured the securities in fixed income, in bonds. So he has a first-hand understanding of the mechanics of what's happening. And I'm just so honored. So I can go on. I told him I can talk about 30 minutes about him, about his background, all the things he has done. But briefly, Jean-Claude has been in business for over 17 years, bright man. He's graduated cum laude from University of Maryland with in business administration with emphasis in finance, especially international business. And then he had got his MBA from London School of Business, and he's a chartered financial analyst. He is worked extensively in different backgrounds from trading desk at Forex, NatWest, to some of the largest banks in Germany, and from Deutsche Bank to Nomura to Hypo Vereinsbank, which is the second largest bank in Germany. I mean, he's done it all. And in I believe 2009 or so, he started his own capital management, and he will talk about that, structuring special securities and in alternative energy. And basically, he's done it all. And we are just so blessed to have him. He's actually a fund and portfolio manager right now. He does a family office. So all that, I'm not going to talk much more. I'm eager to hear what Jean-Claude has to say. Again, it's a very timely thing, especially after FOMC meeting today. So Jean-Claude, the floor is yours. We are grateful to have you, and I'm eager for your presentation. Thank you very much, Jean-Claude.
Thank you, Ramin. I really appreciate it. Can everybody hear me? Is it on? Okay, cool. Appreciate the introduction, Ramin. Thank you very, very much. So the topic of today's presentation is the art and science of investing in bonds. And so I have three goals in my mind. It's tough to cram, all this information on, bond market and the capital markets into a 50, 60-minute presentation. So I thought about three main goals for today's presentation. One is to give you an idea of what the US bond market actually looks like, its importance and its purpose and its constituents. The second is to give you some tools to help you look at bonds as an investment. So if you should ever look at a bond, I want to give you some tools with which you can, identify whether it's a good or a bad investment. And finally, the third thing I want to talk about is I want to leave you with some of the pressing issues that are currently affecting the bond market. So without further ado, let's go to our first slide. The U.S. bond market is fairly large. It's as of today, it's about 55 trillion US dollars. It's significantly larger than the equity market. It's about 50% larger than the US equity market, which stands at about 30 trillion. And it actually makes sense because, capital seekers are more likely to, borrow money than issue equities because debt is cheaper than equity. And the second reason is one of the major participants in the US bond market is the US Treasury. As you know, it's fairly active these days. Not only is the U.S. bond market fairly large, you have to consider it grow. I mean, it doesn't grow by 12 trillion a year, but the issuance of bonds annually is about 12 trillion. So that's a lot of paper that needs to find a home. Now the bond market doesn't grow by 12 trillion a year because you have issuances that are paying off or that are being refinanced by this new issuance. But still, every year, $12 trillion of bonds are being issued. And on the next slide, we'll see, who the major, the players are in terms of issuing these bonds. So first of all, the breakdown of the U.S. bond market in terms of debt outstanding, the biggest participant is the U.S. Treasury. It's almost about 40% of the bonds that are issued annually come from the U.S. Treasury. Second are, the area that I worked in, which is, mortgage and asset-backed securities. Mortgage-backed securities are around 23%. This includes, home mortgages and commercial mortgages, and ABS is separated here, but it was part of, the group that I worked in. It would fall under there. ABS is mostly asset-backed securities, which is securitizing trade receivables, credit cards, equipment loans, personal loans, car loans, all sorts of assets like that. The third group is corporate bonds. These are, companies issuing debt to finance capital projects or, whatever their capital needs are. And federal agency securities are Freddie Mac, Fannie Mae, and entities like that support the mortgage market. And you have Sallie Mae, which supports the student loan market. Money market transactions are mostly trade receivables by companies and shorter term bonds. So the major players in the bond markets are threefold. So you have issuers on one side, you have investors on the other side, and then you have the service providers that that help the issuers finance whatever they need to finance and turn these into instruments that investors can buy. And so the main issues, as we saw, U.S. Treasury, federal agencies, municipal entities, I forgot to mention earlier, is about 9% of all bonds outstandings, by municipal bonds. They are fairly important because most of these securities are tax exempt, and so many high income investors look for those because they don't want to pay too much in taxes. So they end up with large municipal bond portfolios. Corporates, again, as the main issuers, and financial product issuers is what I call, entities that issue mortgages or credit cards or specific loans. For example, and we'll talk about it later, I created a company about 8 years ago that financed renewable energy projects and energy efficiency projects for commercial companies or commercial real estate owners. And so I would fall under these financial product issuers. Service providers are the entities that help these issuers finance their projects. Mainly it's investment banks that help structure these bonds and help sell these bonds to investors. I worked at these investment banks in a structuring group. We worked with the rating agencies, and we'll talk about them later as well. These rating agencies rank or rate these bonds and give them a rating so that investors can, better, understand the risk of these bonds. Law firms, we deal with law firms who are the entities that actually create the bonds in terms of all the legal documents. You cannot believe, in terms of when we structure our bonds, how many legal documents and contracts we have to go through. It's just amazing. We also work with the accounting firms that help us do the due diligence. For example, if we're doing a mortgage-backed security deal, we'll have accounting firms go through all, there are maybe 10,000 mortgages that have to be looked at. And so these accounting firms go through a lot of the databases that we created and make sure that they're all okay. Monoline insurance companies also play a role in terms of what they do is sometimes you have bonds that are rated single A or double B, or let double B no, but let's say triple B, and you want to sell it as a triple A bond. So what you could do is you could go to a monoline insurance company and they what's called they wrap the bond and turn it into a triple A or double A bond. Right now, I don't think there is a monoline insurance company that's triple A anymore. So it would be up to double A, for example, and they insure the bond. And we'll talk about it later as to why we would want to do that. And finally, have broker dealers that serve a very, very important role, and they basically help sell these bonds to the investors. And finally, so who are the main investors for these bonds? Biggest investors are insurance companies that have, so basically insurance companies have long-term liabilities when they sell their insurance, and they sit on a lot of cash from the premiums that they receive up front. So they have a lot of positive cash flow, and they need to deploy that cash and invest it so that they can cover those liabilities that are going to happen later in a few years or whatever time. And so these insurance companies then look for, they have a big chunk of their portfolios are in bonds because they're pretty safe investments. Pension funds are another big group of investors that invest in these bonds, endowments, private foundations. We see hedge funds, mutual funds and bond funds, ETFs. Even banks are investors because banks, from a regulatory perspective, have to hold a certain amount of reserve capital. And so what they do is instead of holding that in cash, they have certain assets, bonds that they're allowed to keep. So it's mostly treasury bonds or maybe some AAA ABS bonds that they're allowed to hold as collateral. And finally, you have family offices and retail investors that invest in these bonds. When I was at Deutsche or Nomura, when we were creating these bonds, our primary investors were mostly insurance companies, pension funds, and endowments, and those were the ones that we would sell to. And broker dealers, would then in the secondary market probably sell, or if they ever get those bonds, sell them to retail investors. So we always talk about how important the bond market is, and so I wanted to spend some time, talking about why the bond market is so important. And the bond market is very important because it underpins the economy. So as I mentioned earlier, the bond market is what finances these car loans, these mortgages, companies' trade receivables, capital expenditures, corporate projects. They finance their inventory and equipment financing through the bond market. Governments finance their debt through the bond market, infrastructure projects, etc. So all these projects have to be financed, and they're financed through the bond market. And money as such is the lifeblood of the economy, and the cost of borrowing and lending that money is the interest rate. And so that's why you see the Fed placing so much emphasis. They want to make sure that the system, the bond market system, works appropriately, that there is that there's no hiccups in terms of the money flowing from, investors to borrowers. And you also see that the bond market is a pretty good indicator of economic conditions. In fact, it reflects economic conditions about 6 to 12 months out. You can see that happening right now with, interest rates on the long end starting to shoot up, showing that, economic conditions 6 months, 12 months out are going to be much better than they are now. In fact, FOMC this morning talked about how they raised their, economic growth assumption for the last quarter. from 4 to 6%, I think it is. So, and also sometimes you probably heard that if you have an inverted yield curve, it's a signal that there could be a recession coming up 6 to 12 months out, and um, you have to consider, the economy is a fairly complex beast, and so sometimes you can't really rely on it 100% of the time, and there are false signals. When we're looking at bond market from an investor's perspective, it's different from the equity market that you're used to. It's much, much less liquid than the equity markets. Most of the investors that you encounter in the bond market are buy and hold investors. So they effectively buy these bonds and keep them in their portfolios until they mature. We saw also that there were so many, the bond market is so much larger than the equity market. So for example, if you had Pfizer, you have basically one stock of Pfizer that people buy and sell on a daily basis, but Pfizer could have 10 different bonds outstanding with different maturities, different coupons, different durations, different credit qualities even. And that's just one company. And so there's so much diversity in the bond market. And so, this is one of the main reasons that you don't see bonds traded on an exchange. So most bonds are traded over the counter and via broker dealers. This here is an example of a broker dealer, a bond offer from a broker dealer. In this particular case, it's a municipal bond for a building ski resort, for the building of a ski resort of chalets and a hotel in Vail, North Star Community Services. And so, I would get an email like that saying, hey, we have these bonds in inventory. Would you be interested in buying those and putting them in the portfolio? And so, I'll take a look at that and either say yes or no. So it's not like I go on a TD Ameritrade and look at, what's happening to the stock price of a certain company going up and down. We don't have that in the bond market. Here it's mostly, I get an email like that, or you could call the broker dealer and say, hey, I heard Pfizer has this bond outstanding. Do you have it in the inventory? I would like to buy it. And then either they have it in inventory, and you would buy it from them, or if not, they would give you something similar to it, or they would go and try to source it for you. Here, the reason I put this up, this is EMMA, the Electronic Municipal Market Access. It's the closest we have in terms of a database of all the municipal bonds that have been traded. So you can type in the QSIP. QSIP is the identifier of a particular bond, and you can see when it was issued. You can get all the information on the bond, all the legal documents, the reporting, everything on that. And you can even look at the trading of it, of whether it's been traded, and how it's been traded. And the reason I put that up is I wanted to show you how little this is the same bond we just looked at, how little it's been traded in the last 3 months. So it's only traded 55 times year to date. Compare that to a stock that trades 500,000 times a day. It's a very, very big difference. So why invest in bonds? And I have a picture here of the offensive line of a football team, and it's sort of a good metaphor for what bonds do. So bonds are similar to an offensive line of a football team. They're there to protect you. They're there for capital preservation, to provide cash flows in good and bad times, and they provide an income stream. And most importantly, they also provide diversification. So usually what happens if the stock market goes down, you have people flying into risk off, and you would go into bonds, they'd see bonds go up. And certain types of bonds called TIPS, they also provide certain inflation protection. There is also capital appreciation in bonds. I was mentioning the story earlier. You can buy distressed bonds at cents on the dollar, 10, 20 cents on the dollar. and if you know what you're doing, and you know that they will survive, they go back up to 100 cents, then you have significant capital appreciation. But this is not the usual bond investor. Usual bond investors look for income and diversification. So in terms of diversification, this is the efficient frontier, and the reason I put that up is just to show that by combining, bonds and stocks in a portfolio, you not only reduce your risk, but you increase your return, and this is the efficient frontier, showing that's in terms of the best allocation of stocks and bonds. The more risk you would like, the less the allocation towards bonds, and the more the allocation towards stocks. And sort of the rule of thumb has been, in all these years back, is a 60-40 stock bond portfolio. This is what you usually see. People have 40% in bonds and 60% in stocks. And so they get over 11% return, while minimizing their volatility. But this is how it used to be, and things are changing slightly, because this is a graph of very long-term view of interest rates going back all the way to 1962. And you see how interest rates have continuously dropped since the early 80s to where we are now at like an absolute bottom. And so this means that when interest rates go down, stocks go up. That's the relationship between stocks and bonds. But right now, the bonds are so expensive because interest rates are so low. Then there's not much more room for bonds to go up anymore. How much further can interest rates drop? And so the question is, how good are bonds in terms of diversification if we're at this situation where one side of the risk equation is capped? And so it's something, it's foods for thought, something to consider, whether bonds provide that much diversification anymore, since we're at the very, very top. So having gone through bond market in general, I wanted to go a little bit more detail in terms of when you guys are looking at bonds, what to look out for. And so there's certain vocabulary that you need to know and understand, and when looking at bonds. So the first thing is the CUSIP. So the CUSIP is what identifies the actual bond. So every bond has a unique identification number, and it's registered, and that's the CUSIP. So when you're talking to bond brokers or broker dealers, you always refer to the CUSIP. And the bond itself has a coupon rate, and that is effectively the interest rate of that particular bond. It's the interest rate at which that bond was issued. And so now there are different yields, because when you issue the bond at 100, let's say, and then 2 years from now interest rates go up, the price of the bond falls. And vice versa, if interest rates fall, the price of the bond rises. So as the price changes, the yield of that bond changes as well. So if prices fall, the yield of that bond rises. And there are various yields on a particular bond that you need to pay attention to. One is the yield to maturity. The yield to maturity is if you keep that bond until it matures, that's practically the internal rate of return of that bond that you're receiving. But many of these bonds are not held to maturity because they have call features. So let's say you have a 20-year bond on the city of LA, for example. Well, after 10 years, the city of LA might have the right to purchase that bond back at 100. So that's what's called the yield to call. So you might not keep that to maturity just because you might lose it to the call. So when you're investing in bonds, you want to know what that yield to call is. And what also is provided when you're investing in bonds is the worst basis yield, because a lot of times you have a variety of calls on a bond on different dates and multiple call dates. And so what they will provide for you is they look at the yield to the worst possible call date. So it gives you the worst possible yield if you invested in that bond. Um, Another important, word to know is the duration. What effectively the duration is, it's a measure of sensitivity of the price of the bond to a change in interest rate. So let's say interest rate go up by a certain percentage, the duration will tell you by how much the price of your bond is going to fall by. Another way of looking at it, and I always looked at it this way, is how much time it takes for you to recover half of the present value of the cash flows from the bond. So if you had a bullet bond that pays no interest and just pays off one amount in 10 years, the duration of that one bond would be 10 years. But if you have, let's say, a 20-year mortgage that pays off interest and principal over the life of that instrument, the duration of that bond is about 10, 11 years, something like that. That it's important to know what the duration is, because when looking at when I was doing my transactions, we would look at the duration to hedge our portfolios. So if on the liability side I had cash flows that were that had the duration of 10 years, then I would look at the 10-year treasury as a hedge or as a basis for those cash flows. Finally, well, is the Dscr, which stands for debt service coverage ratio. So when you're looking at bonds, they have covenants. And these covenants basically say that if a company's ability to service our debt drops by a certain percentage, we consider this bond in default. And we place these debt service coverage ratios at a rate even before the company goes, into bankruptcy, because we want an early warning system. And but effectively, these bonds are in breach of that covenant, and they would be considered in default. Usually, it depends on the bonds, but you would have to look at the covenants of each bond, what that debt service coverage ratio, minimum debt service coverage ratio is, and what the current debt service coverage ratio is, to see how much, how much security you have in terms of how much can the performance of the underlying portfolio or the performance of the company drop before your bond is hit and goes into default. As we continue in terms of the important items of a bond, the face and par value of a bond is important. It's the original dollar amount of the bond. So in our earlier example, when I issued a bond, I issue it at 100, and that's the face and par value. But then if the interest rates go up and the price of the bond falls, then that's no longer the face value, that's the sale price, because you're now buying something at a discount and you're no longer paying 100 for that bond, but you're paying 90 or 80 for that bond. And so bonds are always quoted on a scale of 100. And so when you look at a bond that says 90, so you're basically paying 90 cents on the dollar for that bond. The face value could be $200,000, and you're paying basically 10% less than that to buy that particular bond. Many, like a big chunk of bonds are rated, some are not. But if they're rated, they get a rating by the rating agencies. And we're going to look at these different types of rating and what they mean a bit later in the presentation. But in general, the rating gives you a probability of default, an actual number that we will be looking at. So, for example, if you have a AAA rated security, there is a 0% chance of a default on that security. It's effectively risk-free. As I mentioned earlier, some bonds are insured by monoline insurance companies, and others are not, but it's important to note which ones are. And you cannot rely 100% on these insurance, on these wraps, because they're in certain situations they might not pay. Like in a normal insurance case, the insurance companies might fight the fact that they want to pay it. In fact, I know of several deals where the bonds were insured by the monoline. One was actually here in California, which was a securitization of a film library, and it was insured by one of the monoline insurance companies. And that transaction went south, and the insurance had to pay up, but they ended up not paying up because there was fraud involved. So it ended up in the courts, and I'm not sure what ended up happening, but when you see bonds that are insured by monoline insurance companies, you should always research the underlying bond and make sure you're buying it on its own merit. Now, very important, two legal documents. The most important one is the prospectus, also called the offering circular, and for municipal bonds, it's called the official statement. It's something akin to, and when you're looking at stocks, you look at an annual report. Well, when you're looking at bonds, you can look at the prospectus. It's a document that can be up to like 300, 400 pages, and it includes all the information required for the sale of the bond and for you to understand the bond issue. It includes all the covenants, the background information, the structure, and it's a fairly detailed document, and it also gives you market background as well, to give you sort of a market background or even background on the company itself. So sometimes, even if you're an equity investor and you're looking at a company, whether you want to buy stocks in a certain equity, if they have bonds outstanding, it might be worthwhile to look at their bond prospectuses, because there's a lot of good market information about the company in the prospectus. The other important document that exists is the rating agency pre-sale report. This is only for bonds that are rated. These rating agencies, they write a report in terms that basically support their rating. And these reports are fairly detailed and give you a lot of market, company, background information, how they rated it, and it's always a good source of information, even for equity investors. I like looking at these pre-sale reports because they give you sort of very good, very, very good information. On the next slide, we're still looking at the same bond from earlier in the email, but I just wanted to talk about some of these words we saw. So first of all, here you have the CUSIP number. This is the identifier for the particular bond. Note that this particular bond is not rated, the North Star Community Services. The maturity of the bond is 2037, but look here, it's callable in March of 2021. So it's callable this month, effectively. Now this email is from 6 months ago or something like that. So the original coupon of the bond was 5%. But because this is a distressed kind of bond, it's trading at 59 cents on the dollar, 59.878. So the yield to worst, the yield to maturity are 9.942%. So it's no longer the 5%, but this is the 9.942%. The face value of the bond, so, is $1,000. I can see that because the principal here is $203,585, and it's trading at 59 cents on the dollar. So the face value was $340,000 for this particular group of bonds. And they're looking at 340 bonds. So it's $1,000 per bond. So this particular bond, the face value was $1,000 per bond. Sometimes when we were doing our transactions, we didn't want retail investors to buy them. So our face value was $250,000 per bond or $100,000 per bond, because we wanted to limit it only to institutional investors. So we could do things like that. But if you wanted retail investor to participate in the bond issuance, you would drop it to $1,000 like they did in this particular case. This is an example of a bond offering, an offering circular. This is Banco Santander. I just wanted to show you what these documents look like. And this is a fairly large issuance of 1.5 billion euros at a coupon of 4.375%. And it's issued at 100%. So it's issued at 100. And it's a fairly large transaction. And in fairly large transactions like these, you have a lot of banks, investment banks, join in to help sell these bonds. And in this case, you have 1, 2, 3, 4, 5, 6 joint lead managers. You would have one bank structure the bond, and then you would have in the syndication, you would have 1, 2, 3, 4, 5, 6, or sometimes 5 join in terms of selling the bond at the closing. The next here's what's inside the offering circular. It's the same one. So when you get these, a lot of it is legal documentation and legal wordings, but some of the really important sections are the risk factors. They'll go in detail as to what are the risks of the bond. The use of proceeds, what's this bond used for, and in this case they're not, but sometimes when my transactions were fairly complex, so you had covenants, and so it would describe the structure of the bond and the covenants as to when a bond would go into default, and this is all very, very vital information. This is the market information I was mentioning earlier. So if you're looking at, if this is even relevant for equity, investors, there's a lot of information here in terms of the market that, in this case, Banco Santander is working in, and you can glean a lot of information about the market and form a view on the stock itself. Continuing, this is an example of a pre-sale report. This is a structured finance deal. This is actually, we'll talk about a little bit later, it was in the industry that I worked in terms of specific type of loans to renewable energy and energy efficiency projects. And Hero, this was the residential type of those loans, and in this case they worked with Kroll Bond Rating Agency, and this is what when they come up with the rating, they write this bond. This is the size of this deal was at $104 million, and this is what these look like. It gives you the collateral, the process, the legal considerations, cash flow based assumptions. It gives you all the information relevant to making the rating, but it also includes good information on the company itself and on the asset itself. So if you were looking at a company on an equity perspective, if they had a bond outstanding, you get their pre-sale report, you get some really vital and very good information in these pre-sale reports. I spent a lot of my time was spent working with these credit rating agencies in coming up with the rating and negotiating these ratings with them, and working on these pre-sale reports. This was the result of weeks and months of negotiations with these rating agencies. So continuing, our look at bonds. We looked at the bonds in particular, but let's step back a level and just look at the general risks to consider when looking at a bond. And there are a variety of risks when you're looking at the bond, and these are all priced into the interest rate. So one is the term premium, and so the further, the longer a bond is, the riskier it is, because you're waiting a much longer period of time for you to get back your money, and a lot more can happen. So there's a premium in terms of the longer you go, the more expensive they get. Liquidity premium is always there, especially with my structured bonds, because they were so complex that not many investors would buy, would even look at them, and so you had a limited amount of a special group of investors that would look at them. So and most of them would be buy and hold, and so there's this liquidity premium that should things go bad and you wanted to sell your bond, there might not be buyers for them. Um, uh, Ratings. So if a rating is placed on a bond, let's say it's rated AA, that doesn't mean it's rated AA for the life of the bond. So there's always things that can change throughout the life of the bond, and these bonds can be downgraded or upgraded. And so when they're downgraded, it means that something's bad is happening that wasn't expected, and then they get riskier. And then when they get riskier, the interest rates goes up, the yield on these bonds go up, and the price goes down. And so when you're holding these bonds, you might lose money. And so there is a premium or a risk associated with that, which is the downgrade risk. And of course, there is a default risk associated with every bond, because not every bond is risk-free unless it's the US Treasury or AAA types of bonds. Then in terms of the bonds that I was creating, these were the complexity premium. Those, my bonds sometimes are so complex that I would sit, sometimes I would really have to sit for half an hour trying to turn certain mathematical concepts into legal language. And it sounds easy, but it's really difficult to turn something that's very easy in Excel, in terms of, if this happens and this happens, then we will divert the cash flows from here to here, to this account, to that account, and from this bond to that bond, and to turn that into language and make sure that make sure that it's understandable and correct is not easy. And then so there's for complex bonds, there's this complexity premium associated with it. You'll see in structured bonds, they have higher spreads than usual. Finally, there's volatility premium. That's the risk that the risk of the price movements depending on the interest rates. So all this has to be included in the consideration when you're looking at bonds. If you've decided to invest in bonds, how can you go about to do it? First of all, if we look at Treasury bonds, you can actually go directly to the US Treasury, to their website here, www.treasurydirect.gov, and you can buy Treasury bonds directly from the US Treasury. You don't even have to go through a broker dealer or anything like that. The second way of doing that is over the counter via regional broker dealers or national broker dealers, like Charles Schwab, TD Ameritrade, or Fidelity. You call them up and you say, hey, I'm looking at this particular bond. Can I buy it? Or do you have it in inventory? Indirect ways of buying in bonds, and these are not suggestions. These are just, I'm just writing them down so you have them as a reference. You can buy bond ETFs. So some that are like relevant these days, things, these like the short-term Treasury bond ETF, SHI, medium-term, and then the long-term Treasury bond ETF, TLT. You have TIP, which is TIPS bonds ETFs. This is significant because these are inflation protected bonds. So if you think inflation is going up, and you want a safe asset in your portfolio as a diversification, this might be a good idea to further research because you're covered by for any rise in inflation. And then you have investment grade corporate bond ETF, LQD, and then a variety of other corporate bond ETFs that you can look at. And finally, you can look at mutual funds as well. And here are like a couple examples. of mutual funds that you can look at if you were interested in investing in bonds. I wanted to spend some time explaining again, how the capital markets operate and why they're so important. And I wanted to do that, using my company as an example. So in 2006, 2007, I came to the US, and after having been in the securitization structuring industry for many years, and I saw there was a law that allowed municipalities to issue what's called an assessment to finance renewable energy and energy efficiency projects on buildings. And so the real estate owner who wanted to finance these loans would pay back their loan through their property tax. And I noticed that because it's a property tax and they pay it back through their property taxes, they are always first in line. So they're senior to the first mortgage. So should anything happen and they don't pay back their loan, and the building is foreclosed upon, the first to get back their money is the tax lien, and then the mortgage gets paid. And I noticed that these loans, these particular solar loans, or if you want to call them solar loans, I call it actually PACE loans, PACE assessments, they had an interest rate of 7% and a loan to value of about 10%. And then any mortgage was underneath them in terms of credit ranking. And mortgages had, a loan to value of 70, 80% and had an interest rate of 3 to 4%. So I immediately thought there's a major arbitrage opportunity here, because I'm earning more than twice as much in interest rate on a loan that is 10 times more secure than a regular mortgage. Why is it 10 times more secure? Because it has a loan to value of 10%, and I need the building to drop by 90% before I lose any money on it when it's foreclosed upon. And because I always get paid first. So I thought, this is a great idea of coming up with a program to finance these types of loans. So how can I go about doing that? Well, I can go to a bank and say, can you give me a loan because I want to, start this loan program. Banks, the size of the loan program that I wanted to have was, at least 100 million in size. That was, our expectation in terms of how many loans we could issue in our first year. And in fact, if you look at the residential one, after 2 years, they had issued over $1 billion in these types of loans. So a bank doesn't have enough capital to issue that much as a loan for you. So that's out. The next thing is, where can I get this capital from? Well, the best way to do that is to access the capital markets. And luckily, I had all this experience. So how do I go about of doing that? Is I could go straight to those investors we looked at earlier, which were the insurance companies, the endowments, and all these big investors. But the problem with that is they have certain mandates in terms of what types of assets they can buy. So for me to come and say, hey, I want to create a portfolio of loans and sell it, give it to you, can you finance that to me? They'll say, no, we can't invest in that. We only invest in bonds. So what I need to do if I wanted to access the capital markets is turn basically this portfolio of loans that I want to create and turn that into a bond that is rated, that I can sell in the capital markets to these investors. And so that's what I went about to do. And when you do that, when you sell these types of bonds to investors, they're going to come back to you and say, hey, we just want access, or we want exposure to the risk of the loan portfolio. We don't know solar, in this case, I called it solar capital, but it was a different name. So I call, we don't want exposure to risk of solar capital. We don't know you guys, we don't know what's going to happen to you. you could go bankrupt any day, and we don't want that risk. So we only want the risk of, in this case, a portfolio of solar PV loans with a loan to value of 10%. That's what we want. And so the only way of doing that is by creating a special, what we call a special purpose vehicle, which is another company. And I put all these loans that I create, I put them in this special purpose vehicle. And so now this special purpose vehicle is the one that issues the bonds. And the bond investors buy these bonds directly from the special purpose vehicle. So by doing that, even if solar capital goes bankrupt, or if there's fraud involved or whatever, if it doesn't matter, because the capital bond investors, they have access directly to the loan portfolio via the special purpose vehicle. So this is how, and we do that not only with loans, we do that with car loans, with credit cards, with mortgages, with all equipment loans, equipment leases. For all these transactions, the issuer is always a special purpose vehicle, because it allows bond investors to have specific specific exposure to a specific risk. They don't want to have any risk of solar capital. That's and so what happens is, in this particular case, Solar Capital sells the loan to the SPV. The SPV issues bonds to the capital markets, 100 million. SPV receives 100 million, and then provides the cash to the the issuer, to the sponsor in this case, called Solar Capital. And then Solar Capital has now the funds to issue these loans to any company or project, or project sponsor or borrower, so they can purchase the solar PV and pay for it. And then what happens is, over time they pay back the loan, and in this case it wouldn't go through Solar Capital, it would go directly to the SPV and pay back those bonds. So this is just, I just wanted to show you how important the capital markets are for all these things that we take for granted every day. All these loans and all these loans, credit cards, etc., that we take for granted every day. These capital markets allow companies like Solar Capital and to create programs to provide these loans to companies or private persons, and allow them to work on projects and grow the economy. I wanted to also show you in my next slide the economics of Solar Capital, of what happens. So in our case, I was saying they were issuing loans at 7%, and so this is the income they were getting from the loans, and so we would issue these bonds to our investors. And you would have two tiers of bonds. So the senior bonds would be maybe 80% of this, and that would be rated AA, maybe AAA, and it would have a rate of 4% because it's a double or AAA bond. And then you would have a junior bonds that would have a rate of 7 to 15%. Sometimes you don't. I mean, this is just an example. In terms of our solar loans, this is what we had, and then so this 7% pays the 4%, pays a 7 to 15%, and then there's always cash left over. And it goes back to, this cash goes back to the Solar Capital. So Solar Capital makes money in two ways. In terms of it gets paid an upfront fee by issuing the loan, sort of the upfront fee for the loan, and then it gets paid on the residual, on the equity retention of what's left over after the loan. So after the senior bonds are paid off. And so here it's very important to see, if interest rates go up, then this directly affects how much equity is retained and the rate on these bonds as well. Because if interest rates go up, then this 7% will not be enough to pay this. And if that's the case, then the deal can't work. So what this means is that if interest rates go up on this side, then we will have to raise rates on this side so that these economics work. And if interest rates go up, these rates go up, and then finally the consumers' rates go up as well. And so this is how the rates in the capital markets affect the rates on for the everyday person, and even for companies then too. So I wanted to talk a little bit about the role of the rating agencies, because they are fairly important. They play a fairly important role. There are three big rating agencies, which are Moody's. Well, the two big ones are Moody's and S&P. Fitch was always the third, and now we also have Kroll and DBRS. So these are the five major ones. And usually you see in a very, very large issuance, like the one we saw, Banco Santander, 1.5 billion. I did a deal which was almost 5 billion euros, a mortgage-backed security deal. If it's like 5 billion euros, that's a fairly large deal. We want to make sure that we can access as many investors as possible. Some investors require that you have both rating agencies rating the deal. Some just look for Moody's. Some just say, well, we just need S&P. And so for us to cover every possible investor, because we have 5 billion to sell, so we would actually get a rating from Moody's, from S&P, and from Fitch. And so you would see all three ratings on the rating agencies. Now, on smaller deals, you might not need all three. So on smaller deals, you would have just Moody's or just S&P. Sometimes we would play one against the other, and we would put a lot of pressure on them, of course, to get the best rating possible. And then we would go with the one that gave us the better rating. A lot of times they end up very similar, but there's this play. It's also important to note that who pays for these rating agencies is the issuer, not the investor. And this has been a criticism of this rating agency model in the bond market, is that the issuers are paying for the rating to have their own bonds rated. So there is a conflict of interest in a sense, but the ratings are separate. They are independent. But it does happen that investment banks do put pressure in terms of getting the best possible ratings. And for this reason, now you see a lot of big investors have their own analysts. So they require ratings from the rating agencies, but they still have their own analysts look at these bonds and rate them themselves in-house. Ever since the collapse of 2007, 2008, there was big criticism about those rating agencies, and as a result of that, you had some others come up, which is Kroll and DBRS. In fact, my solar deal, I worked very closely with Kroll and DBRS because they were hungry and wanted to help out with new deals. So when they rate a transaction, they rate it on a scale. And the scales are fairly similar between S&P, Moody's, and Fitch, and of course Kroll and DBRS as well. AAA is basically prime, and it's basically risk-free. And then the scale goes down, as you can see, AA, AA minus, AA plus, single A plus. Anything below BBB minus, in Moody's has a slightly different scale. Instead of the minus and the plus, they have Baa1, Baa2, Baa3, but it's basically the same idea. Anything below BBB minus or Baa3 is considered non-investment grade. Everything above it is considered investment grade. The lower you go, the more speculative these instruments become. And then when you're in CCC, it's extremely speculative. They are just, probably just minutes from default. And here you're already working with a workout situation. And I would not recommend looking at these types of bonds, because you need to be an expert in bankruptcy laws, and you need to know exactly what's happening once the workout happens. And you have hedge funds that focus or that are experts at this, and they have legal teams that look at these types of bonds, and they these types of bonds are trading at cents on the dollar, maybe 10 cents, 15 cents, but these hedge funds know exactly what they're doing. So for the retail investor, I would not recommend this area unless you have specific knowledge. So what do these ratings mean? So the ratings are effectively tell you the probability of default, and this here is the Moody's idealized default probability table. Each rating agency has its own as well, but they're very, very similar. So on this side, I have the rating, and on here I have the years, because and it gives you the probability of default. After 1 year, after 2 years, after 3, 4, 5, 6. So pretty much AAA is pretty much 0. But the lower you go, the higher the probability of default. So if you have a triple C rating, you're at there's a 50% chance that within the year you're going to see the company default on this bond. This is also for equity investors. I think it's a good idea to look at, if you're looking at an equity and investing in equities, you're looking at their to invest in them. You should look at the bond rating that they have, and it gives you here an idea as to what is the likelihood that their bonds are going to default within the next year or 10 years. So it gives you an idea of the riskiness of that particular company. But looking at default is not only the only thing you should be looking at. You should be also looking at the expected loss. So the expected loss is basically the probability of default times the loss severity. So if you have a probability of default of 50% and the loss severity of another 50%, this gives you the expected loss of that particular bond. And so here, for example, if we're looking at the worst case scenario, which is one notch below default, why is it that your expected loss is less than 100%? Well, because there's collateral backing those bonds. So in this case, there's your expected loss on a triple C minus or CAA3 type bond after 1 year is 28%. So you'll get 70 cents of the dollar back after a workout. So how did they come up with these tables? Well, they've looked at the last 50 years and they looked at the data, and that's how these tables are created. Finally, last thing about ratings, which I think is very important to note, is that ratings move. So when you get a rating, doesn't mean you're going to keep that rating for the life of the bond. So this is a fairly important table. It shows you, what is the likelihood of your AAA bond to remain AAA after 5 years in this case. So this is called the ratings migration table, and all the rating agencies have something like that. And I've put that in there just to give you an idea of, even if you have a AAA bond, after 5 years, there's still a chance that there's, 20% chance that it's going to go down to 20%, there's a 4% chance it's going to drop to single A. There's about a 1%, a little less than a 1% chance that it'll drop to a triple B. Here, if you have a triple C type bond, after 5 years, there's a 60% chance that you're going to be in default. Investment grade bonds in general, as you can see, they're fairly safe. There's only a 2% chance that after 5 years you're going to end up in default. So that's fairly safe. But then once you go to non-investment grade, as you can see, it goes up pretty substantially from 8% to 25% to 60%. So you might get higher return in these junk bonds, if you want to call them junk or non-investment grade, but the risk of default after a certain amount of time is fairly high. Looking back at the bond itself, the bond rate. So we're going to look at the bond rate now, the interest rate on that bond, and what the constituents are of that bond rate. I think it's important for you to know, what drives the bond rate and how it moves. And it's not straightforward because there are several elements to it. So first of all, if you look at the treasury bond, which is like the risk-free bond, there's still certain elements to it that move it. So first of all, you have the real risk-free rate. That's the bottom. That's like the real risk-free rate. And then you have a liquidity risk premium, the maturity risk premium, and the inflation risk premium. And so these are all the risk premiums that are added on to the interest rate to make the treasury bond rate. So the longer the maturity, the higher in general, the higher the rate of the bond, unless you have an inverted curve. But these are sort of the elements of the treasury bond rate. In addition to those, when we're looking at a corporate bond or any of the other bonds, you add the default risk, the structuring risk, and all these other risk premiums. And these are called the spread. So these three are called the spread, and then you have the inflation spread, and then you have these premiums, the maturity risk and the liquidity risk premium. And this is what drives, and we're going to look at each of these individually now to see how these affect and how they affect the bond rate. So first of all, the lowest one is, you have the long run, the 10-year treasury rate, which is sort of the basis for all the bonds that we have. And, it's been in a long decline over the last, since 1982. And so as interest rates, drop, prices of bonds go up and make the price very expensive. And so now, next aspect of that is we were looking at that on the various 3 months, 2 years, and 10-year treasury rates. All of this are basically the main element of the constituents of your bond interest rate. And depending on the maturity of the bond, if it's a short-term bond, you would look at the 3 months, and if it's a long-term bond, you would look at the 10-year or maybe whatever the duration of your bond would be, and that would be the basis of your bond. And if you can note here that you can see that the shorter term, this 3 months and the 2 years, are pretty much almost as low as they can go. They can go any lower. And you can see here the long term is beginning to move up. And why is that? Because why is that moving up? So going back to this, so we have the real risk-free rate, the liquidity risk premium, maturity risk premium. Well, in the long end, this is basically the same. This is basically the same. So what's driving this long-term rate to go up? Well, it's the inflation risk premium. So the inflation risk premium is what's driving this up. And this, you can see that here. So here we have the second constituent of the bond rate, which is the 5-year expected inflation rate. And you can see here how it's rising. And that's what's causing those bond rates to go up. Now, the Federal Reserve had a goal of 2%, which is here. This is the 2%. And now recently they said, we're not going to target 2%, we're going to target an average of 2%. And so you see this here rising above this. So they've changed their policies. So next is, so once we've covered the inflation rate, what is the next? Well, that's the bond spreads, the one I spoke about. And these bond spreads, they depend on your rating and on the asset itself. Well, in this case, an example is the corporate bond spreads, but you could have these bond spreads for structured bonds, for asset-backed securities, for mortgage-backed securities, for credit cards, and they're all different. And this is just an example of the corporate bond spread. So this means that in addition to the risk-free rate, you would add about 54 basis points to get to the AAA corporate bond spread. So you get a bit of a pickup in yield. AA, 65 basis points, which is 0.65%, single A, 0.81. And here, triple C, you add another 6.65%. So to the risk-free rate, and you get the current, corporate bond spread. But I wanted to show you that these corporate bond spreads are not fixed. They change in time too. And here you can see this is the corporate bond spreads of the AAA bonds. You can see they can move radically as well. So this is another area that you should look at when looking at bonds. Not only is it the treasury rate or the risk-free bond rate that affects the pricing of the bond, but also the spread that's particular to that particular bond. And these spreads can be different for, in this case, it's the corporate bond spread, but let's say for credit cards could be completely different, and they could blow up and cause your bonds to go down in price because for some reason credit card bond spreads went up. And so here, I just wanted to show you that these spreads can be volatile as well. But look at what's happening here. AAA bond spreads last year coming down. Why? People are buying financial assets. Corporate bond spreads, high yield, similar to the same scenario, much more volatile. But look at this, from over 10%, we're now here below 5%. We're here at like 3%, which is as low as it's ever been. So, very expensive bonds these days. This is triple C bond spreads. This is like one notch or a few notches before actual default. Look at that. That's a spread of less than 10%. I mean, this thing is about to default, and you're like asking for 10% here. This is as low as it's ever been. Now, I wanted to show you the real rate. We spoke about the real rate. So that's the 10-year Treasury minus CPI. So there are certain instances where it can go negative. And so if the Fed decides to cap the interest rate, if they decide to cap the interest rate at a certain percentage and inflation goes up, it won't allow the rate to go up because it's capped. So the only way to have that equation work out is for real rates to go negative. And then you have instances where the real rate goes negative. And when the real rate goes negative, well, means that you shouldn't be holding any cash because, it's very, very inflationary. And so, good areas to invest in would be gold and, actual assets where, real assets where when real rates go down, they usually go up. So it's something to look out for, what's going to happen to the real rates in the next few quarters. So I wanted to conclude this presentation with current macro issues that we should look at, and I've been sort of alluding to them throughout the presentation in terms of so some questions that don't necessarily have the answers to, but I think we should look out for what's going on and what the discussion is in the capital markets about them. Well, first is the U.S. government is issuing a tremendous amount of debt, and how will rising rates, and we've seen them rise now, how will rising rates affect the US government's ability to service that debt? What will the Fed do? Will they cap it to make sure that the US government can service that debt? Same question for the corporate sector. You have, the bond market has been, the rates have been so low that it's been very easy to borrow money. And so you have a lot of companies with a lot of debt. And so how will rising interest rates affect the corporate sector? how will, if rates start rising on the long end, what will happen to these companies in terms of debt service? Can they service that debt? Can they refinance that debt? And, what happens to their risk of bankruptcy? How will bond market investors react to rising rates? This is a really important one, because rising rates means that the bond prices are dropping. And so you have all these bond investors that are sitting on bonds that are very, very, very expensive at the moment. And if interest rates start rising and the bond prices start dropping, will they start selling their bonds? And will there be a run on bonds when all of a sudden everybody wants to get out first? And who gets out first? I don't know if that's going to happen, but that risk exists, of course. And not only bond market investors, but foreign governments that own U.S. treasuries. What will they do? Do they want to hold bonds, U.S. bonds, with potential inflation rising? Um, they might want to sell it, which would cause this snowball effect. But these are the issues that the Fed is he has to tackle. Combined to that is, how far will the Fed allow the long end interest rates to rise? Talk about Operation Twist, where they will start capping. They will start capping the long end and make sure it doesn't rise too much, so you don't have these issues that I spoke about earlier. It's I don't know the answer to that. Will MMT and these loose fiscal policies by the U.S. government, we just had this stimulus package, and then we have another, I think it's $2 trillion coming, for infrastructure. Will these loose fiscal policies lead to inflation? And will the Fed be able to control this inflation? If they cap those rates, will real rates turn negative because you have inflation and they've capped the interest rates, so real rates will turn negative or have the potential to turn negative. How will that affect the economy? And finally, we've had interest rates so low for so long. You have a lot of companies borrowing a lot of money. How many of these companies, usually, if what happens is, if the economy overheats, interest rates go up, weak companies can't make it anymore, they go bust, and new companies start. But if you keep interest rates very low, you don't have this cleaning mechanism in the market anymore. And so you have these zombie companies, I call them, walking around. We don't know, these are zombie companies. Buffett said, when the tide goes out, you'll see who's swimming naked. And this is a situation where you have companies that, shouldn't really exist, but because interest rates are so low, they're able to exist, but they might be destroying value and not adding value. And they're just kept alive because interest rates are low. So these are sort of the issues that I see at the moment that you should consider, and on a macro level. And then so this was my last slide. I have one more slide, and these are some resources that have a lot of information, where you can research more. And the Federal Reserve Bank of St. Louis, those slides I had are from there, called the Fred slides. It's amazing the amount of information that you can get from them. There's a lot of information in Standard & Poor's, Moody's, Kroll, the BRS, the rating agencies. A lot of it is free. You just need to sign up. You don't have to pay for it. If rating reports and these, the offering circulars you can get from, usually you should be able to get them from your broker dealer if you're interested. So you should say, hey, can you send me the offering circular or the pre-sale report for that particular bond? And they should be able to source those for you. When the bond markets, they use a system called Bloomberg, and that system is fairly expensive for the retail investors. I think it's $20,000 a month. And so there was a person, he came up with what's called COIFIN. It's sort of like a similar to Bloomberg, but it's free right now. And so it has all, you can, look at bond charts and, interest rates. And it's very similar to Bloomberg, but it's for the retail investor, and it's free right now. And finally, Emma, it's sort of the #1 database for municipal bonds or for the municipal market. It has everything you need to know and all the information required for any particular mortgage, for any particular municipal bond. I wish they had that for other bonds, but it doesn't exist. But for municipal bonds, you have this great database called Emma. And with that, I conclude my presentation. I hand it back to Ramin. I open for any questions. So I hope you enjoyed it. I know it was a lot of information packed into a short period of time, but I tried to, give you as big of a picture as possible.
That was tremendous, Jean-Claude. I really want to thank you. It was this actually could have gone for hours because there's just so much depth. And
yeah, it's a lot of information.
And I think what you did in about an hour was about 10 hours worth of information. And I just have to follow up on what the title was, Art and Science. And I think a lot of times with investing and trading, we get more used to the art of things and being subjective and forget how important the science is. And when it comes to investing in bonds, which actually reflects in investing in equities, that science matters. And that's what this was, I thought, was very timely, Jean-Claude. It was very informative, and I hope our members, found it as informative as I thought. And I think it opened a lot more doors on top of that, like you rightly mentioned, when it comes to equities, it's actually more important to look at the debt side of things, and you get a lot more information about the health of that company just from looking at their fixed income and debt side of things. So with that, I really want to again appreciate your time, all the work you did. Sean, we can stop the recording and then we can start for the questions. So
sure.